kind of a segue over into quant funds. We talked about that some or maybe all of you might have exposures in quant funds as well. Mm-hmm. And can you go sort of the thinking and how that book may grow or change? I was thinking just now because somebody mentioned Third Point, and they're more activists, but are sort of moving into data quant-ish style.
I think the ways that managers and liquid markets use technology is changing rapidly. I think that everyone's generally eager to sort things into binary categories, where I think that the reality is that life is generally somewhere along a spectrum. I think that most managers, there's very, very few kind of pure play discretionary or purely quant. I think most managers fall somewhere in between. I think that the ability to leverage technology as part of an investment process is increasingly important. At what point do you cross a threshold that makes you a quote-unquote quant manager? I don't know, but I think that, I think quant and mostly the ability to leverage technology within an investment process is, I think, increasingly important. It's something that we do have some exposure to, and I think it's something that we're doing a lot of work on increasing.
So we're all getting more tech exposure. That's what I keep hearing today.
Well, I think that I think we're living in a unique period in time in that we live at a point where I think that the technological logarithmic curve is basically at the intersection point with kind of an evolutionary 2% productivity gain line, which I think reflects basically the pace of human evolution. And the fact that those lines happen to be near the intersection point, I think, is the only reason that quant and technology are really even a controversial topic at this point. I wouldn't even say it's controversial, but I think 10 years from now, I think that the ability to leverage technology is only going to become more important.
And I think about it in terms of a spectrum. So we do have a mostly quantitative strategy in the sense that we have a systematic macro allocation. It's very quantitative, although usually fundamental ideas drive what they research. So that would be the most quantitative. And then in the middle, there might be fundamental strategies that push quantitative data to their team. And then what I'm seeing more of is fundamental managers that have internal teams that are looking at data to help make more of the buy-sell decisions. And we're seeing this much more common than we did even a year ago.
And we dipped our toe in the water with one manager, which was really put in as much as anything a hedge to the equity part of the portfolio. So far, I mean, we still have a lot of managers who haven't been in the portfolio for a year, so it's still hard to really assess too much at this point. But every time the equity markets have been down, they've been up. So far, it's working the way we had hoped, but again, too short a time period to really assess.
Well, sort of picking on what you said about dipping your toe in with the manager, you also are willing to seed or fund first-time managers and take perhaps an equity stake, is that right?
We have done one equity stake in a firm, and we have done some first-time managers both on the private side as well as the hedge fund side. So I think generally we're trying to stay with newer, younger managers. It's a theme that some of the other speakers have been saying today, and maybe the rest of the panel would as well. Not to the exclusion of larger managers, but there are a few of them in the portfolio. And I think one thing that we've been sensitive to is the transition at the management level with some of the larger funds. Founders and maybe even second generation people leaving. And so is the fund today what it was when it created that track record? So looking at the smaller, hungrier, younger managers, and we recently officially created an emerging managers program, which we've done nothing yet because we've been doing other things, but it's really to focus on kind of being a seed investor. And we're not putting a whole lot of criteria around it in terms of, what fits in here, but it's open at this point to really looking at coming in with new managers.
I think when you do that, I think a sub-portfolio approach makes a lot of sense, because I think that when you layer business risk onto investment risk, which is hard enough, I think that the uncertainty band has to widen out. And so the odds of saying that you have found the one are lower. So I think it makes sense to have a sub-portfolio.
Well, and what we did was to really think of it as one individual portfolio manager size. So they're going to be much smaller, and really with the thought of kind of 2 years, and then you either increase or they come out. So if you don't have the conviction to move up with that manager, then it's probably time to move on.
We've also done, I think we've done about 6 day one investments. Our results have been mixed. We've had, none that I would say are A's and none that I would say are C minuses, but they haven't been as strong as we would like. And so we're very cautious. We call it being careful of the shiny object, because the story sounds really good when there isn't a track record. So it's something we definitely do, but we spend a lot of time doing the research.
Do you think there's some commonality of mistake or structure with some of the first-time managers that's attributable to sort of their sort of median to low-ish grade?
I would say the more complicated the fund and structure was, the more difficult it was for them to be successful in years 1 to 3. So maybe they'll be successful by year 4, but the beginning can be pretty rough.
Mm-hmm. I'm aware of some managers who, again, with the markets like emerging market equities, for example, having a need to redesign, if you will, some of their processes. And we talked a little bit, how do you think about revisiting or re-underwriting such managers in a case like that?
So we will re-underwrite a manager before we make any decision. And I would say half the time we end up staying. We actually prefer hiring someone that's gone through a negative period. We like people to learn from their mistakes. So if somebody's down, that's an ideal time for us to invest with them. So it doesn't mean that just because someone has struggled that we won't be long-term partners as long as they learn.
I agree. I think it's hard to do politically and governance-wise, but I think it's important to do. And my view has always been that if a manager hasn't had a significant drawdown yet, that just means that it's coming.